I need to warn you about something that most investors are completely ignoring. The Federal Reserve is about to make a move that will devastate certain sectors of the market. And I am not talking about small declines. I am talking about the kind of destruction that wipes out years of gains in a matter of months. I have seen this pattern before. I profited from it in 2008 when I shorted the housing market while everyone else was celebrating, and I am seeing the exact same warning signs today in 3 specific sectors that are primed for catastrophic declines. Let me be very clear about my track record. I do not make predictions lightly. When I identified the subprime mortgage bubble in 2005, I was early by nearly 2 years. My investors questioned my sanity. My own analysts thought I had lost my mind. But I understood something that the market refused to see. The math did not work. The fundamentals were divorced from reality. And eventually, math always wins. Today, I am seeing the same kind of disconnect in 3 sectors that have been propped up by easy money and irrational optimism. The Fed's next move, whether it is holding rates higher for longer or cutting into economic weakness, will expose these vulnerabilities. And when the reckoning comes, investors who are positioned on the wrong side will suffer devastating losses. I am going to share the 3 sectors I would short if I had to make a concentrated bet against the market right now. More importantly, I am going to explain exactly why these sectors are vulnerable, what catalysts will trigger the decline, and how the Fed's actions will accelerate the collapse. This is not speculation. This is pattern recognition based on data that most people refuse to examine. Let me take you back to 2005 to explain how I think about these situations. I was running a small hedge fund, Scion Capital, and I started noticing something strange in the mortgage market. Lenders were giving loans to people who could not possibly pay them back. The loans were being packaged into securities and sold as safe investments. And the entire system was built on the assumption that housing prices would never decline nationally. I spent months analyzing the data. I read hundreds of mortgage prospectuses. I built models showing what would happen when the adjustable rates reset and borrowers could not afford the new payments. The conclusion was inescapable. The housing market was going to collapse and take the financial system with it. But here is what most people do not understand about that trade. It was not about predicting the future. It was about recognizing that the present was unsustainable. The math simply did not work. And when the math does not work, eventually reality catches up. The only question is timing. I see the same situation today in 3 sectors where the math does not work, where valuations are disconnected from fundamentals, where the only thing propping up prices is the assumption that conditions will remain favorable forever. The Fed's next move will shatter those assumptions. The first sector I would short is commercial real estate, specifically office buildings and the REITs that own them. This is not a contrarian call anymore. Everyone knows office real estate is struggling. But what most people do not understand is how much worse it is going to get. The pain we have seen so far is just the beginning. Let me walk you through the math because the math is devastating. Before the pandemic, a typical office building in a major city might have been worth 20 times its annual net operating income. So a building generating $10 million a year in rent after expenses would be valued at $200 million. That valuation assumed full occupancy, stable rents, and low interest rates for financing today. That same building might be 60% occupied. The net operating income has dropped to $6 million. But the real killer is what has happened to cap rates, the rate of return investors demand. When interest rates were near zero, investors accepted 4% cap rates. Today, with the 10-year Treasury yielding over 4%, investors demand 7 or 8% cap rates for a risky asset like an office building. Run the numbers. $6 million in net operating income at an 8% cap rate equals a building worth $75 million. That is a decline of more than 60% from the previous valuation of $200 million. And many office buildings have not yet been marked down to reflect this reality because owners are avoiding transactions that would force them to recognize losses. The wave of distress is coming because of how commercial real estate debt is structured. Unlike residential mortgages, which typically have 30-year terms, commercial mortgages usually mature in 5 to 10 years. Over the next 3 years, roughly $1.5 trillion in commercial real estate debt will come due. Much of this debt was originated when interest rates were near zero and valuations were at peak levels. When these loans mature, borrowers face an impossible choice. They can refinance at much higher interest rates, which many properties cannot support with their reduced cash flows. They can inject additional equity to pay down the loan, which most owners are unwilling to do for a depreciating asset. Or they can hand the keys back to the lender and walk away. We are already seeing defaults accelerate. Brookfield defaulted on loans secured by office buildings in Los Angeles. Blackstone had properties go into receivership. These are sophisticated operators with deep resources. If they are walking away, imagine what is happening with smaller, less capitalized owners. The Fed's next move will make this worse, regardless of which direction they go. If they keep rates higher for longer, the refinancing math becomes even more impossible. Buildings that might have survived with a 5% mortgage rate cannot survive at 7%. More defaults, more distress, more forced sales into a market with few buyers. If the Fed cuts rates because the economy is weakening, that creates a different problem. Economic weakness means more layoffs, more companies reducing office space, more vacancy. The demand side deteriorates even as financing costs improve slightly. Either way, office real estate is trapped. The regional banks that hold much of this commercial real estate debt are going to take massive losses. We already saw what happened to Silicon Valley Bank and First Republic when their asset values declined. Commercial real estate losses will create similar stress at dozens of smaller banks. This is a slow-motion crisis that will unfold over the next 2 to 3 years. I would short office REITs aggressively. The stocks have already declined significantly, but they are still not reflecting the true value destruction that is coming. When the loan maturities force price discovery, when the regional banks start recognizing losses, when the distressed sales accelerate, these stocks will fall another 50% or more from current levels. The second sector I would short is the consumer discretionary space, particularly companies selling to the middle-class American consumer. This is a bet that the consumer resilience everyone is celebrating is about to crack, and when it cracks, it will crack hard. Let me explain what I am seeing in the data. The narrative right now is that the American consumer is strong, unemployment is low, wages are rising, spending continues, but this narrative ignores some very troubling trends beneath the surface. Consumer credit card debt has surpassed $1.1 trillion for the first time in history. Credit card delinquencies are rising at the fastest rate since the 2008 financial crisis. Auto loan delinquencies are spiking, particularly for subprime borrowers. Buy now, pay later defaults are accelerating. The excess savings that consumers accumulated during the pandemic from stimulus checks and reduced spending have been completely depleted. During the pandemic, households built up roughly $2 trillion in excess savings. That cushion is gone. In fact, the savings rate has dropped to the lowest level in decades as consumers dip into savings to maintain their spending levels. This is not sustainable. Consumers are spending money they do not have, financing it with credit cards charging 20 to 25% interest rates. At some point, the credit runs out. At some point, the minimum payments become unaffordable. At some point, consumers are forced to cut back dramatically. The Fed's actions have created a delayed fuse on this bomb. Higher interest rates take 12 to 18 months to fully impact the economy. The rate hikes from 2022 and 2023 are only now beginning to fully affect consumer behavior. The tightening that has already occurred will continue slowing the economy even if the Fed does nothing from here. When consumers finally capitulate, the companies that sell discretionary products will be devastated. I am talking about retailers, restaurants, home improvement stores, furniture companies, automobile manufacturers. These businesses have been operating as if the good times will last forever. They have inventories built for strong demand. They have cost structures based on current sales levels. When demand falls, their earnings will collapse. Look at what happened to retail stocks in 2008 and 2009. Companies that seemed healthy going into the recession saw their stocks drop 70, 80, 90%. Some went bankrupt entirely: Circuit City, Linens, N Things, countless others. The consumer pullback was so severe that even well-run companies could not survive. I see similar vulnerability today. Companies like Target, Best Buy, and Home Depot are trading as if consumer spending will remain robust indefinitely. Their valuations assume continued growth or at worst mild slowdown. They are not priced for recession. They are not priced for the consumer capitulation that is coming. The labor market is another warning sign. Companies are starting to announce layoffs. The pace of hiring has slowed dramatically. Job openings have fallen from their peak. When unemployment starts rising, it tends to rise quickly. The virtuous cycle of employment driving, spending driving employment reverses into a vicious cycle where layoffs reduce spending, which forces more layoffs. I would short a basket of consumer discretionary stocks, particularly those with exposure to middle-class consumers and discretionary purchases. When the consumer cracks, when credit card limits are reached, when the unemployment rate starts climbing, these stocks will fall dramatically. The Fed cannot prevent this. They can only choose whether to cause it through continued tight policy or through the economic weakness that would prompt rate cuts. The third sector I would short is private credit and the publicly traded companies with exposure to it. This is the trade that almost nobody is talking about, but it has the potential to be the most devastating of all. Let me explain what private credit is and why it is so dangerous. After the 2008 financial crisis, regulations made it harder for banks to make risky loans. Private credit funds stepped into that void. They raised money from pension funds, endowments, and wealthy individuals, and used it to make loans to companies that banks would not touch. This market has exploded in size. Private credit assets have grown from roughly $300 billion a decade ago to over $1.7 trillion today. That growth has come with a steady deterioration in lending standards. Competition for deals has pushed interest rates down and loosened covenants. Loans that would have been unthinkable 10 years ago are now routine. Here is the problem. Private credit funds do not mark their loans to market the way public securities are marked. They use models and estimates to value their holdings. This means that when underlying borrowers struggle, the losses are hidden until they become impossible to ignore. The valuations reported to investors may dramatically overstate actual values. We have seen this movie before, in 2007 and 2008. Banks held mortgage securities on their books at values that turned out to be fantasy. When reality caught up, the losses were catastrophic. Private credit has the same dynamic. Loans made at low yields to highly leveraged companies in a zero interest rate environment are worth far less in today's high rate environment. But that write-down has not yet occurred. The companies borrowing from private credit funds are increasingly struggling. These are typically middle market businesses with heavy debt loads. Higher interest rates mean higher interest expenses. Economic slowdown means lower revenues. The combination is lethal for highly leveraged companies. Default rates are rising and will continue rising as the economy weakens. When private credit losses become undeniable, several things will happen. The funds will have to mark down their portfolios, revealing losses that investors did not anticipate. Pension funds and endowments that invested in these funds will face shortfalls. And the publicly traded business development companies and alternative asset managers with private credit exposure will see their stock prices collapse. I would short BDCs and alternative asset managers with significant private credit businesses. Companies like Ares Capital, Blue Owl, and others have been beneficiaries of the private credit boom. Their stock prices reflect the assumption that the good times will continue. When the credit cycle turns, when defaults spike, when the hidden losses are revealed, these stocks will crater. The Fed's next move will accelerate this reckoning. If they keep rates high, more borrowers will default under the weight of expensive debt. If they cut rates due to economic weakness, that weakness will also cause defaults as revenues decline. Either path leads to the same destination. Private credit losses that have been hidden will become visible, and investors will panic. Now let me step back and explain why I believe the Fed's next move specifically will be the catalyst. Because timing matters in short selling. Being right but early can be just as costly as being wrong. The Fed is trapped in a way that most observers do not fully appreciate. Inflation remains above their 2% target. The economy is showing signs of strain. The federal debt requires over $1 trillion annually in interest payments. There is no easy path forward. If the Fed keeps rates elevated to fight inflation, they will break something. Commercial real estate defaults will accelerate, consumer spending will collapse, private credit losses will mount. The economic pain will eventually force their hand, but not before causing significant damage to the sectors I have identified. If the Fed cuts rates to support the economy, they risk reigniting inflation. But more importantly, rate cuts in the face of economic weakness are an admission that the economy is deteriorating. Markets often sell off when the Fed cuts because the cuts confirm fears about the economy. This is especially true for cyclical and credit-sensitive sectors. Either scenario is negative for the three sectors I have identified. Rate cuts signal economic weakness that hurts consumer spending and increases credit losses. Rate holds or hikes directly pressure commercial real estate refinancing and consumer credit costs. The Fed cannot thread this needle in a way that saves these vulnerable sectors. The timing is likely within the next 12 months. The commercial real estate maturities are coming due now. Consumer credit metrics are deteriorating now. Private credit stress is building now. The Fed's meeting decisions over the next several quarters will determine whether the decline is sharp and sudden or slow and grinding. But the decline is coming regardless. Let me address the risks to this thesis, because every short position has risks that can cause losses even when the fundamental analysis is correct. The biggest risk is timing. I was early on the housing trade by nearly 2 years. During that time, my fund lost money and my investors lost patience. Being right eventually does not help if you are forced to cover your shorts before the thesis plays out. Short positions require careful sizing and risk management. Government intervention is another risk. In 2008, the government stepped in with massive bailouts and stimulus that ultimately supported markets. If the commercial real estate crisis threatens regional banks, regulators might intervene to prevent contagion. If consumer spending collapses, Congress might pass another round of stimulus. These interventions can delay or mitigate the declines I am anticipating. Markets can also remain irrational longer than expected. Investors might continue ignoring the warning signs in commercial real estate, consumer credit, and private credit for months or even years before reality catches up. Short positions have carrying costs that accumulate during this waiting period. Despite these risks, I believe the risk-reward is highly favorable for these shorts. The sectors I have identified are facing fundamental challenges that cannot be solved by hope or optimism. The math does not work, and eventually math always wins. For individual investors who cannot or should not short stocks directly, there are ways to position defensively, reduce exposure to consumer discretionary stocks, avoid REITs with office exposure, be skeptical of alternative asset managers touting their private credit returns. Hold cash to take advantage of opportunities that will emerge when these sectors decline. The broader lesson is to always question the consensus narrative. When everyone agrees that the consumer is strong, that commercial real estate has bottomed, that private credit is a safe alternative to public markets, that is exactly when you should be most skeptical. The crowd is usually wrong at extremes, and we are at an extreme right now in terms of complacency about the risks I have outlined. I do not enjoy being bearish. I do not take pleasure in predicting pain for investors and companies, but my job is to see reality clearly, not to tell comfortable stories. The reality is that three major sectors of the market are built on foundations that are cracking. The Fed's next move will accelerate those cracks into collapses. Commercial real estate office buildings face a wave of defaults as loans mature into a hostile refinancing environment. Consumer discretionary companies face a pullback in spending as credit limits are reached and employment weakens. Private credit faces a reckoning as hidden losses become visible and defaults spike among over-leveraged borrowers. These are not speculative predictions. These are conclusions drawn from data that is publicly available for anyone willing to examine it. The question is not whether these declines will occur. The question is only when, and the Fed's next move will determine whether it happens suddenly or gradually. I made my reputation by seeing the 2008 crisis before it happened. I am seeing similar patterns today. The specifics are different, but the underlying dynamic is the same. Excessive leverage, deteriorating fundamentals, and a consensus belief that everything will be fine. That belief will be shattered, and investors positioned on the wrong side will suffer the consequences. The three shorts I have outlined represent what I believe are the most asymmetric opportunities in the market today. Limited upside because these sectors are already struggling. Massive downside as the fundamental deterioration accelerates, and a clear catalyst in the form of the Fed's upcoming decisions. This is not advice for everyone. Short selling is risky and requires expertise most investors do not have. But understanding where the vulnerabilities are helps all investors make better decisions about their portfolios. Reduce exposure to these sectors, increase cash positions, prepare for volatility. The storm is coming, and the Fed cannot stop it. They can only choose which path leads into it. Let me go deeper on each of these sectors because the details matter when you are making concentrated bets against the market. The devil is always in the details, and the details here are damning, starting with commercial real estate. I want to explain the mechanics of how this crisis will unfold. It is not going to be a single dramatic collapse. It is going to be a slow, grinding deterioration punctuated by moments of acute stress. The first stage is happening. Now, landlords are engaging in what I call extend and pretend. They are negotiating with lenders to extend loan maturities, hoping that conditions will improve before they have to refinance or sell. Lenders are cooperating because they do not want to recognize losses either. But this is just delaying the inevitable. The second stage comes when the extensions run out. A loan can only be extended so many times before something has to give. Either the borrower injects new equity, refinances at punitive terms, or hands the property to the lender. We are starting to see more properties move to this stage as initial extensions expire. The third stage is forced sales, when lenders take over properties or borrowers need to exit. Sales occur at prices that reveal true market values. These distressed sales then become comparable transactions that force other owners to mark down their properties. The price discovery cascades through the market. The fourth stage is bank stress. Regional banks hold hundreds of billions in commercial real estate loans. As losses mount, bank capital ratios deteriorate. Some banks will fail. Others will be forced to raise capital at distressed prices. The credit availability for commercial real estate will contract further, creating a negative feedback loop. We are currently transitioning from the first stage to the second stage. The pace will accelerate through 2025 and into 2026 as more loan maturities hit. The shorts I am recommending are positioned to profit from stages 2 through 4 of this crisis. The office sector specifically is facing a demand problem that cannot be solved. Work from home is not going away. Companies have realized they can operate with less space. Employees prefer flexibility. The pandemic permanently changed how we work. And office demand will never return to pre-pandemic levels. Some bulls argue that older office buildings will be converted to residential or other uses. This is mostly fantasy. The floor plates are wrong for residential conversion. The plumbing and electrical systems would need complete replacement. The costs are prohibitive relative to the values of the finished product. Most obsolete office buildings will simply be demolished. But that takes years and requires owners to first accept that the buildings are worthless. The geographic concentration of pain matters too. Cities like San Francisco, Chicago, and Los Angeles have been hit hardest. Downtown San Francisco office vacancy rates exceed 30%. Some buildings have lost 80% of their value. These are not outliers. They are leading indicators of what is coming to other markets. Now let me expand on the consumer thesis, because the consumer is the linchpin of the American economy. Consumer spending represents roughly 70% of GDP. When the consumer weakens, everything weakens. The credit card data is alarming. Average credit card balances have increased by over 40% since the pandemic. Interest rates on credit card debt have increased to over 22% on average, the highest ever recorded. The combination of higher balances and higher rates means households are paying far more in interest each month. At the same time, wage growth has slowed. The real purchasing power of the average worker has declined over the past 3 years when adjusted for inflation. People feel poorer because they are poorer. Their paychecks buy less than they did in 2021. The wealth effect from housing and stocks has also diminished. Home prices in many markets have stagnated or declined. The stock market gains from 2023 and 2024 have been concentrated in a handful of mega-cap tech stocks. The typical household has not benefited much from these gains. Student loan payments resumed after a 3-year pause. That is an additional $200 to $300 per month that millions of households now have to pay. Auto insurance costs have increased dramatically. Health insurance costs continue rising. The fixed costs of American life are consuming an ever larger share of household budgets. Something has to give. Either consumers cut discretionary spending significantly, or they default on their debts. Both outcomes are negative for the companies selling discretionary products. The only question is whether the adjustment is gradual or sudden. I am particularly bearish on companies with exposure to big-ticket discretionary purchases. Furniture, appliances, electronics, automobiles. These are purchases that consumers can delay when times get tight. They do not need a new couch or a new television. They can drive their existing car another year or two. When consumers start deferring these purchases, the companies that sell them see revenues collapse. The auto sector is especially vulnerable. New car prices remain elevated near record highs. Interest rates on auto loans are the highest in decades. Monthly payments for a new car now average over $700. This is unaffordable for most households. New car sales will decline as consumers keep their existing vehicles longer or switch to used cars. The used car market has its own problems. Prices spiked during the pandemic due to supply shortages but have been declining as supply normalizes. Consumers who bought used cars at peak prices now owe more than their cars are worth. This negative equity makes it harder for them to trade in and buy new vehicles. Auto lenders are seeing delinquencies spike. Subprime auto loan delinquencies are approaching levels not seen since the 2008 financial crisis. The loans made in 2021 and 2022 at peak used car prices are souring as borrowers struggle with payments on depreciating collateral. Let me also expand on the private credit thesis because this is the risk that almost nobody is discussing. The opacity of private credit makes it difficult to analyze, which is exactly why the risks are being ignored. Private credit funds report returns based on their own valuations of their loan portfolios. These valuations use models that estimate what the loans would fetch in a hypothetical sale, but there is no actual market to verify these valuations. The funds mark their own homework, and they have every incentive to mark optimistically. When a loan is performing, meaning the borrower is making payments on time, the fund values it at or near par. But performing does not mean the borrower is healthy. Many companies are making interest payments by drawing on revolving credit lines, selling assets, or cutting essential investments. They are keeping current on their loans while their underlying businesses deteriorate. The concept of payment in kind, or PEAK, is particularly concerning. PEAK allows borrowers to pay interest by adding to the principal balance rather than paying cash. This means the fund reports interest income even though no cash is received. The loan balance grows while the borrower's ability to repay diminishes. It is extend and pretend at the individual loan level. When a borrower finally defaults, the losses are often far greater than expected. The collateral backing the loan may be worth less than assumed. The recovery process takes years and costs millions in legal and administrative fees. The marks that looked reasonable before default proved to have been wildly optimistic. The publicly traded BDCs are required to disclose more than private funds, but their disclosures still leave much hidden. They report net asset values based on their own fair value estimates. They report dividend yields based on income that may not be sustainable. Investors buy these stocks for the high yields without understanding the risks embedded in the portfolios. When the credit cycle turns decisively, BDC stock prices will collapse. Dividends will be cut as cash income falls and losses mount. Net asset values will be written down as the optimistic marks are revised to reflect reality. Investors who bought for yield will suffer capital losses that dwarf the dividends they received. The alternative asset managers like Blackstone, KKR, and Apollo have significant private credit businesses. Their management fees depend on the assets they manage, their incentive fees depend on the returns they generate. when private credit losses mount, both revenue streams will be impaired. Their stocks have performed well but are pricing in continued growth that may not materialize. Let me tie this all together with a timeline of how I expect events to unfold over the next 12 to 18 months. In the first phase, which is happening now, we see continued deterioration in the data. Office vacancies remain elevated. Consumer credit delinquencies rise. Private credit defaults tick higher. The consensus narrative remains that these are manageable problems that will resolve themselves. In the second phase, likely in the second half of 2025, the deterioration accelerates. Major office building defaults make headlines. A prominent retailer announces bankruptcy or massive store closures. A private credit fund announces significant losses. The narrative shifts from complacency to concern. In the third phase, likely in late 2025 or early 2026, the Fed responds to economic weakness with rate cuts. But the rate cuts come too late to prevent the damage. Commercial real estate refinancing remains challenged even at lower rates because property values have declined too far. Consumer spending weakens as unemployment rises. Private credit losses cascade through portfolios. The shorts I am recommending should be sized to survive the first phase when complacency persists. They should be held through the second phase when the thesis begins playing out, and they should be covered during the third phase when the declines become extreme and valuations reach distressed levels. This is not a trade to put on and forget. It requires active management, risk control, and willingness to adjust as conditions evolve. Short selling is a tool for sophisticated investors, not a strategy for everyone. But the underlying analysis applies to all investors. Avoid sectors with deteriorating fundamentals and consensus complacency. Increase cash allocations when risk-reward is unfavorable. Prepare for volatility when the Fed is trapped between bad choices. The three sectors I have identified, commercial real estate, consumer discretionary, and private credit, represent the most vulnerable parts of the current market. The Fed's next move will expose their vulnerabilities. Investors positioned on the wrong side will suffer significant losses. I have been through enough cycles to know that the crowd is usually wrong at turning points. When everyone agrees the consumer is resilient, the consumer is about to crack. When everyone agrees commercial real estate has bottomed, another leg down is coming. When everyone agrees private credit is a safe yield alternative, the yields are masking losses that will eventually surface. My job has always been to see what others refuse to see, to do the work that others are too lazy or too comfortable to do, to follow the data wherever it leads, even when the conclusions are uncomfortable. The data today leads to an uncomfortable conclusion. Three major sectors of the market are heading for significant declines. The Fed's next move will be the catalyst, and investors who ignore the warning signs will pay the price.